Wells Fargo first quarter results are just crossing the wires. When we get straight to our chief markets correspondent, Scarlet. Scar?
Yeah, that's right. We're going to start with earnings per share. $1.04 was the reported earnings per share in the first quarter. Analysts were looking for 98 cents. So this beats even the highest analyst estimate that we've compiled here. In terms of the provision for credit losses, this is the amount of money that Wells Fargo and any other bank sets aside to cover potentially bad loans. This went to $608 million, slightly higher than what analysts were looking for. They were looking for something in the neighborhood of $562 million, and certainly an increase from the fourth quarter, when Wells Fargo put aside $485 million. The bank had indicated that it would build some reserves for potentially bad oil and gas loans as those companies face some challenges because of the falling oil prices. Efficiency ratio of 58.8%. This is an important indicator here for Wells' ability to keep its costs under control. Expense management has been a big theme for these banks as they've been waiting for some kind of loan recovery amid the not sluggish economy, but amid the moderately growing economy that hasn't really gone gangbusters the way so many people had anticipated. Now, in terms of what kind of movement it's having in the pre-market right now, I'm looking for Wells Fargo's share price, and it looks like it's 0.5% to 2/3 higher in the early going here. This follows, of course, J.P. Morgan's earnings report earlier this morning. The stock there is trading higher in the pre-market after first quarter profit increased 12% because of an increase in fixed income trading thanks to higher volatility. I also have the net interest margin, Betty, for Wells Fargo. This is key because Wells Fargo relies so much more on these consumer loans, lending out money. Here, net interest margins was 2.95%. That is down 9 basis points from the fourth quarter. So that net interest margin, which was already so thin, so razor thin, so low, goes down a little bit more because interest rates have not yet recovered. And as so many people expect the Federal Reserve to delay its interest rate increase until potentially September or even later on, that could mean more difficulties for banks going forward.